Committee on Digital Assets, Financial Technology, and Inclusion will come to order. Without objection, the chair is authorized to declare a recess of the committee at any time. This hearing is entitled Bureaucratic Overreach or Consumer Protection, examining the CFPB's latest action to restrict competition in the payments. Without objection, all members will have 5 legislative days within which to submit extraneous materials to the chair for inclusion in the record. I want to recognize myself for 5 minutes to give an opening statement. Today's hearing, Bureaucratic Overreach or Consumer Protection, examining the CFPB's latest action to restrict competition in payments, in my view, is critical because it's going to talk about this large participants in the general use of digital consumer payment applications market. This is the 6th LPR that the CFPB has initiated. And putting aside the egregiously short comment period, which frustrates both members of this committee, the deeply flawed cost-benefit analysis, which are both have become hallmarks of this administration, I find the substance of the CFPB's proposal deeply concerning. The proposal asserts that companies that let you send monies to friend, peer-to-peer, or companies that keep your credit card information on your phone somehow are in the exact same market. Why? Well, just because the CFPB says so. This breadth of the market the CFPB is trying to define has perplexed many on this committee, from potentially covered entities to, as I say, on both sides of the aisle here. Many companies are utterly confused, wondering not only how the rule will be implemented, but whether they're even covered by it. I would argue that this confusion is by no means an accident. The CFPB is trying to cast as wide a net as possible and become a technology regulator. And in many more ways than one, this proposal marks a sharp departure from the CFPB's previous large participation rules. Director Chopra has decided on a whim, and in my view, without justification, that technology companies pose a threat to consumers, and this rule should be viewed as a thinly veiled workaround to get CFPB supervision teams into these tech companies. And that's because once an entity is designated as a large participant, the CFPB can not only supervise the activities, which is what I think the intent of Dodd-Frank was, that originally qualify, but they can actually supervise the entity's business itself. The proposal attempts to establish limits by only capturing those companies with 5 million transactions within a year. So we'd love to hear from the panel on, is that a good number or a bad number? But don't be fooled, this modest threshold is so low the agency will effectively have carte blanche to knock down the door of companies large and small with their fleet of examiners. There's no doubt that this proposal will decrease incentives to innovate in the payment space and leave consumers encumbered with fewer firms from which to choose a payment method. That decreases competition. This LPR doesn't benefit consumers or provide market clarity. In fact, the only people this proposal potentially will benefit, besides witnesses like you, are compliance lawyers. To further expand their authority, the CFPB has decided to capture digital assets under this proposal as well. The CFPB asserts the definition of funds includes digital assets. This is a novel position, and the CFPB justifies the interpretation only in a very small, unassuming footnote. Concerns around this proposal are not strictly partisan. Comment letters were submitted by both sides of the aisle to express concern about the proposal's scope and implications. The CFPB needs to go back to the drawing board, work to protect consumers, and not hinder innovation or expand the CFPB's insatiable reach for more power and scope. We thank our panel of witnesses for being here today. We greatly appreciate your testimony and willingness to work with us. And I now yield to the ranking member, Mr. Lynch of Massachusetts, 5 minutes for his opening comments.
Thank you, Mr. Chairman. Good morning. I'd also like to thank all of our witnesses today for your willingness to help the committee with its work. It is the fundamental mission of the Consumer Financial Protection Bureau to safeguard American consumers against unfair, deceptive, and abusive financial practices and discrimination. The CFPB also ensures that our markets are for consumer products and service operate fairly and efficiently in the interests of consumer access and responsible innovation. In furtherance of its critical mandate, the CFPB recently proposed a rule, as the chairman noted, that will allow the agency to exercise supervisory authority over larger non-bank technology companies that offer digital wallets and payment services. This includes peer-to-peer payment apps and electronic funds transfer apps. Importantly, this rule will place Apple, Google, Meta, and other big tech companies that have moved into the financial services space on par with financial institutions that are already there and are already subject to CFPB supervision. However, unlike large banks and credit unions, these companies do not currently undergo CFPB supervisory exams, periodic monitoring, or compliance checks. They may not even be required to insure company funds or deposits. CFPB action in this area is timely, considering the escalation of shadow banking, that is the migration of core banking activities to non-bank entities, which currently fall outside the scope of traditional bank regulation. The rule is also necessary, given the growing expansion of big tech companies into the financial services sector and their deployment of opaque artificial intelligence technologies. As reported by the CFPB, consumer usage of digital wallet tap-to-pay options in the U.S. has already reached $300 billion, and it's estimated to grow by over 150% by 2028. Moreover, an estimated 2/3 of all Americans, including a majority of low to moderate income users, are now relying on peer-to-peer digital payments, such as PayPal and Venmo. Many of these providers have already launched cryptocurrency payment and transfer options. So it's not surprising that the consumer advocates strongly support the rule. According to the Consumer Federation of America, quote, "We would be concerned whenever the line between commerce and banking is permitted to blur. By closing this loophole, the CFPB is moving forward to hold big tech companies accountable to play by the rules as everyone else." I agree with that statement. The CFPB is not becoming a tech regulator as much as tech companies are becoming banks or are becoming involved in the conduct of banking. By subjecting large tech companies to the same consumer privacy standards that apply to financial institutions under the federal Gramm-Leach-Bliley Act, the rule will also protect consumers against massive data collection and the monetization of personal information. The CFPB estimates that the proposed rule would only apply to 17 entities. The agency has also made clear that its supervision of non-bank institutions is based on risk, size, and financial transaction volume, as well as the extent of state oversight. That is why the rule includes a threshold of 5 million payment transactions annually. I look forward to hearing from our panelists this morning and other stakeholders as this rulemaking process develops. Thank you, Mr. Chairman, and I yield back the balance of my time.
The gentleman yields back. We want to thank our witnesses for being here today and making the time. You'll be recognized for 5 minutes to give an oral presentation of your testimony, and without objection, your written statements will be made part of the record. We welcome the testimony of Carl Holzhauser. Mr. Holzhauser is Executive Vice President of the Corporate Secretary of TechNet. Brian Johnson. Mr. Johnson is Managing Director of Potomac Global Partners, LLC. James Kim. Mr. Kim is Partner and Head of FinTech Industry Group at Troutman Pepper Hamilton & Sanders, LLP. Jack Soloway. Mr. Soloway is a Financial Technology Policy Analyst at the Cato Institute. And Christopher Odenet. Professor Odenet is the Josephine R. Witt Professor of Law at the University of Iowa. Mr. Holzhauser, you're recognized for 5 minutes to give your oral remarks.
Thank you, Mr. Chairman. Chairman Hill, Ranking Member Lynch, and members of the Subcommittee on Digital Assets, Financial Technology, and Innovation, thank you for the opportunity to discuss the Consumer Financial Protection Bureau's proposed rule on defining larger participants of a market for general use consumer payment applications. I'm Carl Holzhauser, Executive Vice President of TechNet, the national bipartisan network of technology CEOs and senior executives that promotes the growth of the innovation economy at the federal and 50-state level. Our diverse membership includes dynamic American businesses ranging from startups to the most iconic companies on the planet. We represent over 4.2 million employees and countless customers in the fields of information technology, artificial intelligence, e-commerce, the sharing and gig economies, advanced energy, transportation, cyber, venture capital, and finance. As you know, technology plays an important role in removing barriers to financial access and empowering Americans of all backgrounds to better manage their financial lives through safe, secure, inclusive, and reliable financial tools, including digital wallets and payment applications. TechNet and our members support efforts by policymakers to adapt and update outdated laws and regulations to meet the growing demand from consumers and businesses for these innovative fintech products. In our view, the current consumer payment ecosystem is highly diversified. Companies across the ecosystem play a wide array of unique roles, each serving different markets and offering different functionalities. Regulations focused on fintechs must always ensure that consumers are protected while continuing to allow for innovation in this dynamic ecosystem to flourish. Unfortunately, the CFPB's proposed rule fails to accomplish both of these goals. Under Dodd-Frank and the Administrative Procedures Act, the Bureau must conduct thorough due diligence before issuing a proposed rule. The CFPB falls well short of satisfying this requirement in this proposed rule. Frankly, the CFPB's lack of empirical analysis underlying its proposed rule is stark and troubling. Because the CFPB failed to follow rulemaking requirements required by Congress, the proposed rule creates an arbitrary market that is not based on data-driven analysis or the realities of the digital payment ecosystem, fails to identify specific consumer harms that would necessitate CFP supervision, and fails to adequately address the costs to the diverse array of companies that could be subject to CFPB supervision. We strongly feel that these deficiencies render the proposed rule defective. Before moving forward, it is critical that the CFPB more precisely and narrowly define the consumer payments market in which it seeks to supervise, and to conduct the empirical analysis required in the rulemaking process. At a very basic level, the Bureau should complete a cost-benefit analysis that adequately considers companies that may fall within the purview of the proposed rule, analyze the cost to the companies rather than using conservative estimates, and determine the cost that may be passed on to consumers. Until the CFPB conducts the analysis required of it by law, TechNet has urged the CFPB to pause the rulemaking process altogether and reconsider the proposed rule in its entirety. Otherwise, this rule will introduce tremendous complexity and uncertainty into the digital payments markets to the detriment of consumers and businesses across our country. We appreciate the subcommittee's attention to this important rule, and I look forward to taking your questions.
We thank you. Mr. Johnson, you're recognized for 5 minutes.
Chairman Hill, Ranking Member Lynch, and members of the subcommittee, thank you for holding this important hearing on the CFPB's proposed larger participant rulemaking. I'm Brian Johnson, Managing Director of Potomac Global Partners. I previously served as Deputy Director of the CFPB, and prior to that, I served on the Financial Services Committee's professional staff. I will address my comments today first to the proposed rule and second to the broader context of recent CFPB actions. As members are aware, Congress gave the CFPB authority to subject so-called larger participants of defined markets for consumer financial products and services to supervisory examinations. The proposed rule would, if finalized, define a market for general use digital consumer payment applications. Larger participants of this market, defined as providers of at least 5 million annual consumer payment transactions that are not small business concerns, would become subject to CFPB exams. There are several reasons for members on a bipartisan basis to encourage the CFPB to withdraw and repropose its rule so that it may engage in a more thoughtful and deliberative rulemaking process. First, Director Chopa's recent public remarks, which are the impetus for the proposed rule, expresses concerns about the potential for big tech companies to engage in various anti-competitive practices. However, the CFPB is not the proper agency to address such concerns. The CFPB's supervisory duty is to assess institutions for compliance with federal consumer financial law, not antitrust law. The proposed rule lacks adequate justification because it is not grounded in consumer financial risks arising from the offering or use of covered products and services within the defined market. Second, the Dodd-Frank Act provides the CFPB with no intelligible principle to guide its definition of markets or selection of larger participants. Rather, it gives the CFPB carte blanche to expand its own supervisory reach. This violates non-delegation principles. Congress should define the boundaries of the CFPB's authority, not the CFPB itself. Third, the proposed market definition is impermissibly broad because it aggregates terms in order to cover a number of disparate functions rather than describes a coherent market for reasonably interchangeable financial products and services. Fourth, the CFPB interprets the term funds to cover digital assets, the effect of which would be to expand its regulatory authority over a large number of new products and participants. This would upend careful efforts by members of Congress to craft a balanced legislative framework for digital asset regulation. This presents a major question of economic and political significance that must be left to Congress to decide. Fifth, the CFPB's cost-benefit analysis uses a decade-old framework to calculate the expected cost of the larger participant examination. In my view, the Bureau's exam cost estimate, about $25,000, understates the true cost of an exam by at least an order of magnitude. The CFPB's failure to update its assumptions and obtain accurate information is a significant weakness in the proposal's 1022 analysis. Finally, without good cause shown, the CFPB departed from its standard practice in order to limit the amount of time available for the public to submit comments on the proposed rule, which is contrary to the spirit of the APA. Now I will address the broader context of recent CFPB actions. Regarding the non-financial consequences of CFPB supervision, I note that CFPB examiners sometimes require institutions to waive attorney-client privilege and turn over protected communications. The Supreme Court has long held that agencies cannot compel production of this information without an express authorization from Congress, which the CFPB does not have. This practice chills companies' consultation with legal counsel, which is detrimental to consumers. Also, the CFPB, unlike the OCC or SEC, does not publish an annual list of exam priorities. As a result, institutions have comparatively less insight into the CFPB's prioritization of compliance risks, and therefore less opportunity to proactively address them. Regarding rulemaking, the CFPB has recently proposed or finalized several rules on so-called junk fees as part of a coordinated campaign to scapegoat companies for rising prices caused by inflation. The CFPB's price controls depart from the traditional federal approach to consumer finance regulation. The politicized allocation of credit and capital through unwarranted market intervention constitutes a severe danger to free markets and consumer autonomy. This is not consumer protection. I urge Congress to use all available means to prevent bureaucratic central planning and overreach. Thank you, and I welcome the opportunity to answer your questions.
Thank you very, very much. Mr. Kim, you're recognized for 5 minutes.
Chairman Hill, Ranking Member Lynch, and members of the subcommittee, thank you for inviting me to testify today. My name is James Kim. I'm a partner at the law firm Troutman Pepper Hamilton Sanders. Today, I'm presenting my own views and not those of the firm or any client of the firm. My testimony and the views I express today are informed by my tenure at the CFPB and my subsequent practice focusing on payments and financial technology. My clients at Troutman Pepper range from banks and other established institutions to medium-sized and early-stage companies seeking to introduce innovative products and expand choices for consumers in the marketplace. From 2012 through 2014, I had the privilege of serving at the CFPB, where I was the lead attorney in the Bureau's first enforcement action involving mobile devices and payments. I also worked with colleagues in the Office of Supervision and supported examinations. and I was a member of an interdepartmental working group focusing on emerging payment products. And since leaving the Bureau, my practice very much focuses on helping companies navigate examinations, investigations, and rulemakings involving the agency. So why is the proposed rule for defining larger participants in the payment space important? Before I answer, it's worth highlighting that there is no question that consumer payments are currently regulated by a host of federal and state laws and rules that are enforced by a combination of the CFPB, federal prudential regulators, the Federal Trade Commission, FinCEN, and many state agencies. The proposed rule does not change the substance of these myriad statutes and regulations. Instead, the proposed rule is important because it seeks to define the larger participants who will be subject to the CFPB supervisory authority. The Bureau's power to examine institutions is the agency's most powerful and least transparent tool. Companies supervised by the CFPB must devote personnel and significant resources to host examiners at their offices, respond to information requests and follow-up questions, and address findings. Examinations are non-public and often last months and sometimes longer than a year. The CFPB typically extends the scope of their exams to the company's parent, affiliated entities, and other business areas beyond the covered activity, in this case, general use payment applications. Examinations lack a third party, such as a court or an administrative law judge, to oversee the process and adjudicate disputes. Companies also forfeit their attorney-client privilege during exams. With these considerations in mind, Congress carefully defined the CFPB supervisory authority by generally limiting supervision to larger banks and larger non-banks who can bear the significant cost of complying with exams. And Congress also mandated requirements before the Bureau can expand the scope of its own authority through larger participant rulemaking. I'm going to just highlight two issues in my opening statement. The first is the rulemaking requirements in Dodd-Frank and duplication with existing supervision by federal prudential regulators and state agencies. Dodd-Frank lays out the requirements for issuing a larger participant rule. And before issuing such a rule, the Bureau must consult with the Federal Trade Commission. That requirement is critical because defining a market is the fundamental prerequisite to determining who's a larger participant within the market. The FTC analyzes market concentration and enforces federal antitrust laws, and therefore Dodd-Frank requires the CFPB to consult with the FTC. Now, the proposed rule states that the CFPB consulted or provided an opportunity for consultation and input with not only the FTC, but other federal agencies. But it doesn't discuss any input from the FTC or any factors determining which products or services should be included within the same market. It's therefore unclear whether the Bureau met its statutory obligation to consult with the FTC, which plainly provides that the Bureau shall consult with its sister agency. Now, turning to duplicative supervision by state and other federal agencies, the proposed rule would create duplicative and overlapping supervision for many companies in the space. The proposed rule mentions that states have supervisory programs, but ignores that many companies potentially subject to the rule already partner with financial institutions who are already supervised and subject to examinations by the CFPB or the bank's prudential regulators under the Bank Service Company Act.
Mr. Kim, you've gone over your time. Your full statement will be in the record.